Okay, good, good. All right, so today I would like to welcome you all for our free webinar. It's about classic chart patterns. It's one of the most used strategies in trading. With you today is Gabi Tahtou. I'm the Chief Market Analyst in both OTM, One Trading Markets, and OCM. One, basically, we have a brokerage company and a cryptocurrency exchange. With this strategy, of course, you'll be able to trade on both Forex, stocks, and cryptocurrencies. So here is the webinar content. We're gonna explain what are chart patterns, the different types of chart patterns like reversal, continuation patterns, how to use the patterns in your trades, how to identify both buy and sell signals, and 5 rules to always follow using chart patterns. In any point in the webinar, please, if you have any question, there's to the right of your screen, there's going to be a bubble. You can click on that and ask your question, and I'll happily answer it. Excuse me if my voice is a little bit choppy. I got a little under the weather, but we're going to pull through. Let's do it. So let us begin together. What are chart patterns? So in technical analysis, a transition between a rising and a falling trend is often signaled by price patterns. So when we move from an uptrend to a downtrend or from a downtrend to an uptrend, we always were able to notice a certain patterns emerged on the chart. And this is basically what chart patterns are. Now, patterns, of course, at the end of an uptrend or downtrend, they can indicate for us an early entry point so we can make our profit. And the same thing, an early exit from a trend so we can actually cut our losses and take our profit. Now, of course, the bigger the chart pattern, the bigger the following movement. And chart patterns, at the end, it's a combination of support and resistance line. So basically, by trading on chart patterns, you're actually using the main strategy of support and resistance, which is one of the most renowned strategies in trading in the world, basically. All right. So these are the chart patterns that we're going to go through today. There are exactly 16 of them. These are the most important ones. They're all very similar. You're going to see how similar they are. Like they're not really complicated. Don't think like 16, that's too much to remember. No, you're going to see it's actually very simple. So we have double bottoms, triple bottoms, head and shoulder, inverted head and shoulders, falling wedge, flags, etc. That's basically it. It's very simple. So let us begin at the start. We have two types of chart patterns. We have reversals and continuations. So reversals means that at the end of a trend, let's say we have an uptrend, the market's going up, we see a pattern that indicates a reversal. That means that the market will be changing its direction from upward to downward. Continuation, on the other hand, it means that the market will continue its upward movement. Simple as that. Now, of course, in both reversals and continuation, we have bearish and bullish. Bullish meaning the market is going up, bearish meaning the market is going down. Okay, so let us begin together by looking at the bearish reversal patterns and the bullish reversal patterns. So these four are called bearish reversal patterns. They indicate when the market is changing from an uptrend to a downtrend. We have four main patterns: a double top, a triple top, head and shoulders, and rising wedge. We're going to go through each one and see how they work. So let us begin with the double top. Now, it got called a double top because it looks like a double top. So notice how the market moves. It forms a double top. Now, the probability of actually this pattern becoming a reality is 75%. So let's say you're trading using, you saw a double top. So there's a 75% 0.01 that the market will actually move as you predicted, which is why a lot of people use chart patterns while they trade. So the double top is one of the most common reversal patterns ever. The double top is defined by two nearly equal heights with some spaces between them. The pattern is complete when the price breaks below the swing low point or the neckline. We call this the neckline. Do you see this blue line right here? This is what we call the neckline, after creating the first high. So the pattern is considered a success when the price, like of the market, cover the same distance following the breakout at the distance from the double high to the recent swing low. So when do we consider this pattern to be actually like correct and a success? When we actually reach the point, this point, like from here to here, this is the point that we need to reach. It's going to be identical to the point where the trend actually started. So let's say this around this area, it was $1. It reached $3, for example, then it went back to 2 to 3. We consider it a success when the market goes from $3 to $1. And it's easy as that. And notice how we set up our trades. So the entry point is actually right after the breakout happens. So right after the pattern breaks below the neckline, that's when we enter, because this gives us a confirmation that the pattern could be a success. The profit, like we said, at the end of the trend, we take it, and the stop loss is somewhere around the middle of the latest movement. That's how we calculate our risk using short patterns. And it's simple as that. Let's go to the next one. This one is called a triple top. Now the probability of triple top is even higher. It's at 79.33% to actually happen. Now, of course, the triple top and the double top are very similar. The only big difference is we have another top here. So the triple top is defined by 3 nearly equal heights with some spaces between them. The pattern is complete, the same thing when the price breaks below the neckline. And we call it a success when it actually reaches the point where the pattern has started. For both entry point and take profit and stop loss, it's exactly the same as a double top. The entry point is just below the neckline. The stop loss is in the middle of the previous trend, and the take profit is at the end of that patterns. Now let us look at head and shoulders. This is one of the highest probability, let's say, patterns out there. When you see a head and shoulders, most of the time it will become a reality. At the end of the webinar, we're gonna go live and look at this, like whatever chart you guys want. You guys gonna see how they actually work, like in real time. So it has an 83.04% of becoming a success, which is a really high percentage. Now, the head and shoulders patterns are statistically the most accurate of price action patterns, like we said. So why do we call it a head and shoulders? Because it similarizes a head and shoulders. So this is the head, this is the left shoulder, this is the right shoulder. What else? So for stop loss, entry point, and take profit, they're very similar in every patterns. So notice how our entry point is exactly below the neckline. Our stop loss is in the middle of the previous trend, and our take profit is similar to where the market actually has started. Now you got to remember we're talking about bearish reversal pattern. This means the market is changing from an uptrend. See how the market started below, then went up to a downtrend. Like we said, the pattern is complete when the price breaks through the neckline created by the swings of two low points, which is these two low points. Now let's look at the last bearish reversal pattern, which is called a rising wedge, which has a 73.03% of happening. Now a wedge pattern represents a tightness in the price movement between the support and resistance. Now this is the resistance on top, the blue line, and this is the support. But notice how as they move, they're getting smaller and smaller and smaller until like they kind of connect like a triangle. In anticipation, will be basically waiting for a breakout. A breakout means that the trend or the market has broken out below or above the current support and resistance. Now the rising wedge is always a bearish reversal patterns. It indicates that the market will be moving in a bearish way. So notice, a rising wedge serve as a reversal if appeared during an uptrend. This is one of the conditions for the rising wedge. So only if the market is actually going up and we see a rising wedge, then we know the market will be going down soon. The other way around, it's going to be a continuation, as you will see if it's a downtrend. We will have an example soon. These are the main bearish reversal patterns. Anybody has any questions so far? Of course, yeah. So let me just read the question out loud. So they're asking about the condition of the rising wedge. This is the rising wedge is the only like patterns and the falling wedge, the same thing, that has a condition. So it only works as a reversal, that it indicates the market will be reversing only if it appeared during an uptrend. So uptrend, the market is going up, up, up. We see the rising wedge, that indicates that the market will be going down. Was that clear? Good, okay. So now let's talk about the bullish reversal pattern. So these indicate that the market was going down. Then it gave us some indication that the trend is changing from a bearish trend to a bullish trend. Now we see the first one is called a double bottom. And it's basically the opposite of the double top. It has a probability of 78.55% of happening, and it works in the same way as a double top works. Notice with me, the trend started here. We're moving low. We reached our first point where the support is. We bounced, we went back again, then we bounced again. We noticed this formation or pattern is forming, and we know it's a double bottom. This indicates basically that the market will most probably be moving up. Our entry point will be above the neckline here. Our stop loss will be in the middle of the previous movement, and our take profit will be equivalent to where the trend or the pattern, sorry, have started. It's very simple. The triple bottom, on the other hand, is the same thing. Notice this. It has a 79.33 probability of happening, which is really high, really good. Same as the double bottoms, double top forms the same way. Our neckline, but we have three bottoms, three tops here. See it? 1, 2, 3. Our entry point will be above the neckline around this area. Stop loss in the middle of the previous movement. Take profit is at the equivalent or where the trend has or the pattern have started. Now let's look at the next bullish reversal pattern. Inverted head and shoulders. I know this is a lot of information right now, but like when we at the end, when we see it, how it actually works on real charts in real time, you'll see how easy it is and how easy is it to notice it. So inverted head and shoulders, like we said, the head and shoulder is one of the most commonly statistically accurate of patterns. It has an 83.44%. These are like a lot of studies has been done over this patterns to actually get these numbers. So that's why the chart patterns trading is one of the most common strategies in the world right now. So head and shoulders, of course, like we said, it's most accurate. The inverted head and shoulders has two swings low, 1, 2, what that we call the shoulders. Okay, and we have the head right here. Our entry point will be above the neckline. Our stop loss will be in the middle of the previous movement, or like, yeah, the movement. And our take profit will be at the end of equivalent where the trend or the pattern has started. Let's go into the last pattern that we're going to talk about reversal, and it's the bullish reversal patterns. We have a falling wedge. Like we said, we had a rising wedge where the wedge, like this wedge, that's this movement was going up. Now it's going down. It has a probability of 72.88%. It represents a tightness in the price movement between the support and resistance. The price basically hypothesized a breakout through the support, which is this. This means the wedge is a reversal pattern as a breakout is opposite to the general trend. So like we said, before we said our condition was a rising wedge is only as a reversal in an uptrend. So it's the same thing with a falling wedge. It's only a reversal if it appeared during a downtrend. Always remember, this is one of the most important conditions for this pattern to work. Because if it appears, if we have a falling wedge during an uptrend, then it's a continuation pattern, it's not a reversal. And these are basically our bullish and bearish reversal patterns. Let's look at some chart on TradingView and try to find some of them and see how they work before we go into the, of course, continuation patterns. Now, could one of you, any of you, give me any product, cryptocurrency, forex, commodities to look at? Anything that comes to your mind? Stocks, whatever. Yeah, sure, we can do Ethereum. So Ethereum, USDT. Here's the chart. Just close this indicator. Let's go on. Sure, 1 hour I guess works. Actually, let's go into the daily. Doesn't matter actually where you look at the time frame. You'll see it on the chart how it works. Notice here with me the first pattern we talked about, which is the double top. Notice how the trend started here. Our first top, our second top. Then notice how the market actually moved after. So this is basically our neckline right here. Notice how the movement, like notice how it's so accurate. That's why a lot of people use it. So the trend started around the 1.68 basically. This is the British pound. I thought we were looking at Ethereum. Anyway, it's a valid example, but let's look at Ethereum. Here we go. Delete this. And let's look at a couple of examples. Okay, we have a head and shoulders here that didn't work out, which is really good because we want to see the failed movement as well. So the pattern started here. We had our first shoulder, our head, our second shoulder. But notice how the market couldn't actually go below. And this is why we set up our stop loss to prevent us from losing so much capital, which is really good. Notice how the market moved from here to here after. That's the importance of actually using a stop loss. Now let's search for some patterns for us. Let's go on another time frame here. There we go. Let's enlarge this. Okay. First thing we look at is this is a falling wedge right here. Sorry, a rising wedge. Notice how it's formed. Some of them are called flags as well. Patterns. See the tightness in the movement. Like this. Then we have a breakout up. Then it went down again after the breakup. Notice here we have a couple of movements that we can look at. The first thing was this double top right here. So it doesn't always have to be symmetrical, so you understand. So it's not always going to be like exactly looking like this. Sorry about that. But like if we move this and see how the chart is working, we can see that it's very similar to a double top. We have our first top, which is this one. We have our neckline. We have our double top. And notice the market moved sideways as soon, which is around this area. This is where the breakout happened. Notice how the market dropped significantly. And that's how chart patterns really work. Here we have a double bottom. Notice with me. First, second, this is the neckline, we close it. This was a successful 100% double bottom because the trend started here. Our first top, our second top, the neckline is right here. We have a breakout, we bought here. We went back up to where it started. It's very simple, it's very elegant, and it works. Are there any questions so far? Mhm. Can I give you a second to see if somebody is typing any questions? It's very simple, to be honest, not very hard, and it's very clear the information about chart patterns. It doesn't require a lot of mathematical knowledge or technical knowledge, just drawings, and we see how those drawings work. These drawings, of course, are based on the psychology of the market, the supply, the demand, and so on and so on. All right, there are no questions. That's great. So now let us talk about the continuation patterns. What does that basically mean? That if we have an uptrend, we see a certain pattern, that means the market will keep going that way. Now we have bearish, which indicates like, let's say we have a downtrend. So the market will be here, downtrend. So the market creates this pattern, then the downtrend continues. And we have bullish, for example, the market's going up. We have a certain pattern and the market continues. Now, the bearish continuation patterns, we have 4 of them. Let's start with the first one, which is a rising wedge. Now, if you remember, we talked about the rising wedge, but we said for a condition to be a reversal pattern, it has to be in an uptrend. Now, notice when it's in a downtrend, it's actually a continuation pattern, a bearish one. That's why that condition was really important to know. So the rising wedge in a downtrend indicates a continuation of the previous trend. Now the trend was going down, we noticed the rising wedge, then it breaks out and it went down again. Of course, it's formed when the prices are making higher highs, notice higher highs, and higher lows right here in the previous movement. The entry point will be just around where the last bottom was. Notice how we took the line from here to here. The stop loss will be at the top of the last peak. The take profit will be when you decide. That's some people like to go 3 to 1, 4 to 1. Depends on your risk calculations, but I prefer always like 3 to 1. So like three amount of the rewards, 1 is the risk. So let's say from here to here is $1. So my profit will be at $3. And the entry point, let's say around 0. Now let's talk about another pattern, which is called a bearish flag. Now flags in general, just remember this pattern, are always continuation patterns. Their probability of happening is around 67.72%. Now, the flag is a continuation pattern that can occur after a strong trending move. So notice sometimes when we look at charts, we see the market actually jumping up really fast. And it creates this strong trend, basically. And then we see the market trend sideways for a while. And that's what causes a flag. Now it's called a flag because it's similar to a flag. Notice how strong movement. Notice it's not like a wedge. So it's not the prices here are not getting closer to each other. It's just a flag. Now it basically appears as a small rectangle that is usually titled against the previous trend and price. Now the best flag patterns have 2 features. The first one is a very strong run in price, like we said, near vertically. Like notice here, if you look at our charts here, we gotta find some kind of pattern here for a flag. Let's delete all of this. Flag, 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 flag. Okay, this is the flag. See how the movement is really strong from here to here? So like in 2 hours, the market jumped from 1,084 to 1,200. Then notice how the market moved sideways for a while. And this basically looks like a flag. That's why we call it a flag pattern. And like we said, it's a continuation pattern. So notice how the market actually continued going up after it. Notice how many flags after one another. Look, notice one. Look at the other one here. This one is way more accurate. From here to here, from here to here. Notice there's no wedging. And notice how the market continued going up. And this is just happening like this is the 17th of July. Today is like the 19th, I think, if I'm not mistaken. So this is like 2 days ago. So we already knew 2 days ago, around the 18th of July, which is yesterday, that the market is due to move up. So people who actually bought around this area were able to make some significant profits because the market was around the 1300. Now it's around the 1600. Let's go back to the webinar. Let me grab my laser pointer. So of course, the pattern is considered successful when it breaks the lower trend line and then proceeds to cover the same distance as the prior trend and move, starting from the outrage of the end. What does that mean? So let's say from this point to this point, it was $10. So when the market actually moves from this point to this point and covers $10, that's when we consider the flag patterns as successful. Now let us continue to the bearish pennant, or pennant, depends how you pronounce it. So it looks very similar to a wedge, but notice how it's very, very, very like at a strong angle. Now the pennant, of course, it's the same way it occurs at a high momentum markets. So when you see markets like the US dollar, for example, or even Bitcoin, like most of cryptocurrency, this is why in cryptocurrency you see a lot of flags, a lot of pennants, because there's high momentums, a lot of high volatility in the market. So the tighter the price formation that occurs can lead to breakout against a preceding trend almost as often as we get continuation. So basically the market goes below, then it starts moving up a little bit, then it continues going below. So pennants are basically, if you guys heard this term, it's called where we call cashing out. So let's say people bought at this or sold at this point, the market went down. They want to gain their profit. They want to exit their trades. So when they exit their trade, they create this movement upward because they were like buying and buying. They were selling before. And this is basically what creates a pennant. Now their probability of happening successfully is considered low if we compare it to the other pattern. It's around 55.19%. The entry point, the same thing, it's going to be at the end of the bottom, the last bottom. The stop is at the top. The take profit, it's when it covers this entire movement. So let's say from here to here, $10. This got to be $10 too. The last bearish continuation pattern, then I'll take your questions. If somebody has a question. It is what we call a descending triangle. Now, notice here, this is also a triangle, correct? Like if you look at here. But here we always have a steady support. It's not moving at an angle. Now, a bearish triangle usually occurs in trends and acts as a continuation patterns. It's defined, of course, by the bearish trending move, followed by two or more equal lows with a series of lower highs, but the same lows. So we reached the first low. let's say this is our support line. Then we got to a lower high from this one. Then we reached the same bottom, then a lower high, then the same bottom and a lower high. It could be 2 times, 3 times, 4 times, 5 times, and so on and so on. Our entry point is going to be below that support line. Our stop loss will be at the top of the previous movement, and our take profit will be equivalent to how long is the trend, or how big is the pattern is. Before we go into bullish continuation patterns, let's see a couple of examples here if we can find some. This is the latest movement, of course. We want to see this actually kind of forms as, we want to see pennies and triangles. So this is the wedge here. It's a small wedge though, like it's not a big wedge. But if you notice the movement from here to here, this is a falling wedge. A falling wedge and an uptrend. Notice how the market broke out and went back up again. This is also a falling wedge if you look at it at this angle. Where's my arrow? One. Now notice how pennants and triangles isn't really that common as wedges and flags and like head and shoulders. Why am I getting a support line again? Oh, okay, that's why. And notice from here how the market actually moved sideways, then went up to this movement right below here. Let's remove these. Look if we can find a triangle. It's kind of similar as a triangle a little bit, but it's not a big triangle. Trying to find something that actually looks very, very like, oh, by the way, this is inverted head and shoulders. Notice here. First, head, second. Look at the movement here actually. This is the neckline. This is how easy it is to actually use sharp pattern. You just gotta notice the pattern, or your entry point will be around the 1128 and 28, where you ride the wave until it reaches like 1200 basically. See, it continued up, but the pattern was successful at this point exactly here. This is your exit point. You can take more risks, but notice like it went back up again, but it went lower again, and up again, then lower again, then lower, 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 lower. So this is how you calculate your risk, but the pattern was complete here. That's the beauty of it. Like that's the beauty of short patterns. What do we have here? We have another wedge right here. This looks like it. Yeah, this is a triangle. Now notice here. Here we go. We found the triangle. So the trend was starting down, correct? But notice how the market didn't cross this point right here. See? 1, 2, 3. But if we look at here, we notice how the market is actually getting lower highs, but it didn't break this point. And as soon as it broke it, like we see it right here. Oh, sorry, I opened my Google for example by mistake. Here we go. As soon as it broke it, look how the pattern is. And look right here. The same thing. Can I make it more clear for you? Here we go. Lower highs, as soon as it broke, notice how the movement actually, this one, from here to here, notice from here to here. This is what we call a successful descending triangle. So it's very noticeable on charts. Notice here, what pattern is this? Could somebody tell me? On this area exactly. I'm gonna close it a little bit. Like this one. I'm gonna square it. Yes, this is correct. Travis answered the question the fastest. So it's basically a triple top. Notice here with me. 1, 2, 3. You don't have to draw so much. 1, 4. This is our neckline. As soon as it broke, we rode the wave right here. The pattern was complete around this area right here. So that's why chart patterns are really like the most actually common used tool in technical analysis, because they're actually easy to notice and they have a high probability of actually happening, which is why we love chart patterns. Now let's talk about the bullish continuation patterns. So we talked about the uprising or upward wedge, rising wedge. Now we're talking about the falling wedge in an uptrend. Remember this, in an uptrend. So the falling wedge in a downtrend indicates a continuation pattern. Notice here. It is formed when the prices is making lower highs and lower lows. Our stop loss will be at the bottom of the head. Our entry is just across the latest top. Take profit will be at the same measurement of the last movement. It's very simple. Now let's talk about the bullish flag, which we actually saw an example on Ethereum right now. Of course, like we said, it's the exact same thing as a bear flag. Like it doesn't actually differ at all. Notice how we need a strong run in price, nearly vertical. A tight flag occurs when the right upper or lower edge of that run. Notice how our entry point is around the latest stop, our stop loss at the bottom of that movement. Our take profit is usually around the same measurement of the last trend. So continuation pattern, like notice here, let's look at it again and see. So I think it was here. It was very, here we go. This is the flag. This happened 2 days ago. Notice the vertical strong movement, nearly vertical. Like it didn't move like this one here. No, it moved very, very high. We have a movement right here between two areas. Actually, let me just grab a triangle. It's gonna make it easier. From here to here. This one like this. So similar as a flag. And notice how the market actually continued going up from here to here. Like at a point it reached 1600. Now we're basically trending around 1572. That's the power that chart patterns actually possess. Like I said, this wasn't like a year ago. Like I'm not showing you examples that happened historically. No, this was actually yesterday. So yesterday we already knew that. We look at the Ethereum chart on a 1 hour base, we already knew that the market will be moving like this. Now let's look at it at a daily base, see if there's anything we can actually find. Now look at this. Who can tell me what's going to happen next? Just by looking at the recent movement of Ethereum. Like look at the patterns, how it's actually like very clear. Exactly, it's a triple bottom. So the trend started here. 1, 2, 3. This was our entry point around the 1250 basically. If you entered around this area, you already made amazing profit, and we don't think the trend is going to end here because the pattern is not complete yet. So most likely we will see Ethereum going back to the 18,000, sorry, yeah, 1800 range in the next couple of days. And in a couple of days, just look at the look at the price of Ethereum, and remember that I told you so, just by looking at the patterns on the chart. Same here, look at the falling wedge right here, near vertical, and we have wedge like this. Continuation, it's a falling wedge in a downtrend. Of course, by the way, I know some of you like might, hey, I might forget this information later. This webinar, I'm recording it and it's gonna be on YouTube. So whenever you feel like you wanna go through your basically knowledge, you'll be able to go through it. Now let us finish with the patterns like we talked to. Laser pointer, here we go. So bullish pennant is the opposite of a bearish pennant. It often occurs in high momentum markets, like we said, after a strong trend move. But the tight price formation that occurs can lead to breakout against the preceding trend almost as often as we get continuation. Like we said, they're not very, you can't count on pennants a lot, but most of the time they will be as continuation pattern. Like we see like 45% is different than the 70 and 80% in double top heads and shoulders. Uh, our entry point will be at the last top. Our stop loss will be at the start of the new trend. Our take profit will be approximately the same length as where the trend has started. Now, an ascending triangle is the opposite of a descending triangle. Notice how we have the resistance is at what that straight line, but we are having higher lows. Now, it occurs, like we said, in trend that acts as a continuation patterns. It's defined by its bullish trending move. So notice how up, equal highs and a series of higher lows. Now the pattern is complete when the price breaks above the horizontal line. This is the resistance, basically, not the support area. The support area is in the bottom. And we consider it a success if the price extends beyond the breakout point, which is this point right here, for at least the same distance as the pattern width. Now, before we go into the 5 rules, does anybody has any questions about the chart patterns so far? We're basically done with the webinar. We just have 5 more rules just to look over because we gotta remember them. They're really important. Other than that, we're really done. The chart patterns are very simple and very easy, like I said, and it could be a powerful tool, especially in the hands of a new trader or even an expert trader. Like I know a lot of trading. I have a good amount of experience in the trading world, and until this day I usually like 90% of the time use chart patterns when I trade because they actually help you a lot, and they are based on the support and resistance strategy, which is one of the best strategies out there. Okay, no questions? Then let's go to the 5 rules to always follow while using chart patterns. Ascending triangles serve as a reversal if appeared during a downtrend. Descending triangles serve as a reversal if appeared during an uptrend. So ascending, downtrend, triangle. Descending triangle, uptrend. Notice here. But if you go to wedges, rising wedge serve as a reversal in an uptrend. So rise, uptrend. Ascending, downtrend. A falling wedge serve as a reversal if appeared during a downtrend. Flags and pennants are always continuation patterns. So when you see a flag or you see a pennant, the probability of happening is actually quite good, like 60-70%. Pennants are a little bit lower, like 50%. But like I said, falling wedges really important, rising wedges, descending, ascending triangle. These are very important patterns that work for us. These are the 5 rules that you always want to remember. I do, like I say, advise you screenshot or just watch the webinar later on YouTube. I'll upload it tomorrow. You can see these rules and you can actually train using these patterns on live charts. This was our webinar, by the way. It was a very quick one. This is my Instagram and my Twitter. I post daily there about news, the great advancements going on in the economic state in both Arabic and English, what's going on with the prices, the forex, the crypto market, the stocks, and so on. So I highly suggest you guys follow me there and you can see everything that's going on. Now let's go into the trading view, actually see some examples on a different product. Give me any product to look at, whatever you guys want. Sure, we can look at US dollar, Euro USD. Okay. So this is the Euro USD movement the last couple of days. Yeah, this is the daily chart. That is correct. All the drawings. And let's look at some patterns. Now, notice here we had an attempt for a double bottom. Let me just remove this and here, 1, 2. But it didn't go, so it didn't go back to where it was, but it actually went down. But let's see how actually look at the falling wedge right here. That's the first line, nearly vertical. Notice how the prices moved, and like we said, a rising wedge in a downtrend is always a continuation pattern. And notice how the market actually continued moving downtrend. Chart patterns could be a very powerful tool, to be honest, if used properly. Like look right here. This is what we say 1, 2, 3, 4 tops basically. It's a very rare, to be honest, pattern that happens, but it does happen sometimes, as you can see. Some people call it a 4 top, some people call it 2 heads, 2 shoulders. Depends. It's very rare, but like we said, so the pattern started here, but it wasn't a full, like it wasn't really successful, because if it was successful, the price should have been reached this area. So it started here, but like 1, 2, 3, and around here 4. This was the entry point for us, but the price did go down a little bit, which was good for the pattern, but it wasn't fully, like we say, successful. Here we have a triangle. Look at the triangle right here, and notice how the movement of the triangle is actually looks very strong. It's even actually from this area. This is where a fake breakout happened. Descending triangle, and what trend is this? This is a downtrend. So if we go here, descending triangles serve as a reversal in an uptrend. That means this is a continuation pattern that usually indicates a bullish movement. And notice the bulls, how it actually moved up. Here we have a head and shoulder pattern. Let me just make it like this. 1, the head, the second shoulder, and the market actually moved exactly as the pattern shows. So sorry about this. Let me just draw the support line. This is why chart patterns are very important, and they're like highly used, to be honest, on across all markets. Like let's look at the Bitcoin. Let's go with Bitcoin, for example. This is the future. Let's go with the spot BTC USDT. Like Bitcoin this is considered a high volatility market. Here we have a double top. 1, 2. Notice the market moved here. Stop. Anyways, notice how the market actually moved here. This was our entry point. Notice how much profit we could have made by just selling around that area. Look at the flags that's happening here, one after another. Like we said, flags and pennants are always continuation patterns. Started here, near vertical. Actually, let's just use the triangle. It continued down. Notice here, another flag, another triangle right here. So there's a strong possibility for for it to actually drop below. Okay, let me answer your question. Favorite time frame analysis and entry? What is your preferences market that works well with patterns? For patterns, you can actually use them with any market and any time frame. For me, when I trade, it depends on what kind of trade I'm going for. So, for example, if I'm looking into crypto, because it's a high volatile market, so like the price could be like today Bitcoin as around the 23,400. But yesterday it was around the 18th, like this was, no, here. Yesterday it was around the 20,000. So that's like a $3,500 difference in one day. So I don't actually use an hour chart or a 4-hour chart on Bitcoin. I usually go for a daily chart on Bitcoin. Like when I trade cryptocurrency, I like the 1-day chart. For Forex, for example, I like the 4-hour and the 1-hour chart more than the daily chart. Of course, you can trade on the daily chart, but I prefer the hourly because I'm more active during the day watching the market, what's going on, the speeches, any data, economical data that comes up. That's basically my line of work. But like, I noticed how the Forex movement is a little bit different. The volatility is not that big as cryptocurrency. And that's why in cryptocurrency, I try to give the trade enough room for it actually to breathe. Because like some people, for example, let's go on a 1-hour chart, okay? Let me show you what I mean exactly. And let me just remove all the showings. So some people, let's say, opened a trade around this area and they wanted to buy, okay? So you want to see how much you want to calculate your risk. So is your risk 2 to 1 or 1 to 1 or 3 to 1 and so on. So notice how like you need to go very high. Like this ratio is 0.52. For it to actually be profitable, it needs to be something like this, which is 2 to 1. But notice in a matter of 4 hours, we actually reached our stop loss. And this is why cryptocurrency, like trading on an hourly basis, is just, it's too risky, especially right now with the market moving like high movement. Like it jumped from, it was around $22,700 to $21,400. So the volatility is just too high in my opinion for the cryptocurrency. That's why I prefer the daily chart for cryptocurrencies. See, like in the day, like if I decided to sell here, for example, let's go with the short. I have enough room to breathe. Like we want to go 1 to 2, for example, or 2 to 1. So you have enough room for it. Like in the next 4 days, the trade will be going. And you'll see, like if the reaches this area, you can just stop and close the trade and minimize your risk, minimize your losses. Any other questions? Yeah, yes. Okay, so the question is, do we have leverage in our brokerage house in OTM? Yes, we do have 1 to 500 leverage. Of course, if you're interested, our sales department will be in contact with you to explain all the details and all the to provide all the information that you require to be able to trade with leverage. In cryptocurrency, we have spot trading right now, which is really kind of what I prefer, especially because high volatility market. We do have plans in the future to add futures and options trading, of course, into cryptocurrencies. So that will always be something to look forward to. The minimum amount to open an account is $100, I think, if I'm not mistaken. And after all, it depends on the person, but the minimum is $100. I always prefer to start with a little bit higher than $100 because let's be a little bit realistic, making money in $100. So if you made $10, which is basically like in the real world, it's not really a lot of money, but that's 10% of on your investment, which is actually really good if you look at the statistics. But some people like they look at things really kind of like in a non-realistic way. So like they want to make $10,000 from $100, which is like it's possible, but like the chances are not with you; they're against you. Yep. All right then. If no more questions, thank you all for watching this webinar with me. I was Gabby Dahta with you today. I highly suggest you guys follow me on both Instagram or Twitter. You'll see a lot of valid information that can help you trade and be informed and on the market. I'll be conducting, like always, I have almost one webinar every 2 weeks around that area these times. The next time it will be in Arabic, in the Arabic language. I haven't decided what it is yet, but I do have a couple of plans. I might do chart patterns for people who missed it, or I might do something else like other indicators. Like I have a lot of things prepared. I was thinking about maybe doing the ADX indicator. We'll see. And that's it. I also suggest you guys register if you speak Arabic for our CEO, I think CFO, sorry, CFO's webinar. It's going to be on the 25th of July. It's going to be how to actually trade professionally. It's going to be in Arabic. احترف تداول خطوة بخطوة, step by step. That's going to be very important for Mr. Yazan Shafi. Thank you all for coming today, and I'll see you guys next time. Have a great day.